think that the Fed's message is quite consistent and quite clear.
I think the Fed needs to engage in some serious soul searching.
They are really worried about repeating the 70s mistake.
Those procedures got inflation very, very wrong for a very long time.
The financial contagion risk is much lower today. Unfortunately, we're dealing with the economic contagion risk.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It is 5 a.m. in New York, 10 a.m. in London, and 5 p.m. in Hong Kong. Our top stories today. A U.S. Navy destroyer makes a show of force passing through waters claimed by Beijing in the South China Sea. That comes as Chinese warplanes cross into Taiwan's air defense zone. Investors will have some important data to consider this week. 3 Wall Street banks are reporting earnings, and of course, we're going to get one key inflation figure released on Wednesday, plus a tough start to the year for Apple. Personal computer shipments, they're called Macintosh of this company, falling 40%, leading the rest of the industry. Watch Lenovo, Dell, and HP in today's trade. Welcome to Bloomberg Surveillance. This is the early edition. Good morning from New York City. I'm Matt Miller with Kriti Gupta. Anna Edwards is off today. But Kriti, we've got a lot going on in terms of individual movers, single stock stories. What's the broader market look like?
Yeah, single stock stories, broader market stories, but also a little bit of geopolitical news. It's all factoring in kind of a wonky day where you have actually Europe mostly closed. A lot of the Asian markets closed as well, which creates a very light volume environment for what we're seeing in futures. Check it out. S&P futures unchanged right now, and you're going to see that throughout most of the pre-market session. Really light volume out there because few people really want to make a decision when they don't have their international counterparts, and that is a big part of the equity story today. So expect perhaps some big swings in individual names, perhaps not on the benchmark level. The bond market, though, to me is really interesting. 3.36 on the 10-year yield. In the 2-year yield, you were seeing sustainably below 4%, Matt. The 10-year yield, that 3.36 handle is really interesting because even though you do have payrolls that came in just a little bit hot, and CPI that could also come in hot on Wednesday, the yield is still marching closer and closer to 3%. So something really to keep in mind as we talk about just how long does the Fed have to stay hawkish. Something that the market is pricing will not be long at all. The other piece of the equation I want to talk about is the currency market, because of course we know a lot of the traders off today around the world. But to me, the dollar story is interesting. And I actually brought up dollar MEX here. You are looking at about an 18 ratio. What's important to keep in mind is that this is how light volume is, that the Mexican peso is the biggest index contributor to the Bloomberg Dollar Index. You can find that on your Bloomberg terminal. But it's interesting because it's coming on a day, or I should say after Friday data that shows that inflation, even in Mexico, very commodity focused, very commodity exposed, is also easing. And nevertheless, you do see a little bit of strength in the Mexican peso relative to weakness in the dollar. And Brent crude, Matt, trading at an 85 handle. Once again, a big part of the commodity story.
All right, yeah, absolutely. We're watching those prices, although, they remain relatively subdued after the single-day jump last week. They were pretty stable after the production cut that we got last Sunday. Let's get to some geopolitical news. Taiwan says it has seen Chinese military drills around the island like this before. Foreign Minister Joseph Wu tells Bloomberg the maneuvers are on par with the reaction last year when then House Speaker Nancy Pelosi visited. China began the drills after Taiwan's president met with House Speaker Kevin McCarthy in California last week. John Liu is Bloomberg's executive editor for Greater China. He joins us from Beijing. So, John, we've seen these kind of drills before, Chinese warplanes coming into Taiwan's air defense identification zone. But now, the news part of this, the U.S. has sent warships through the South China Sea.
Well, Matt, there's a couple of things going on at the same time here. There are drills that are planned to start tomorrow between the United States and the Philippines in the South China Sea. That's where that U.S. guided missile destroyer passed through in what the U.S. Army or the U.S. military describes as a freedom of navigation passage. That is obviously causing more tension with Beijing. Already, the situation around Taiwan very tense. We've seen lots of planes, lots of warships around Taiwan. One difference, we have seen a simulated launch of missiles by the Chinese. You'll remember back when Nancy Pelosi visited, they actually launched real missiles that went over and around Taiwan.
Well, talk to us a little bit about the aid here, the military aid that may or may not be in part of the conversation between the Taiwanese president and Speaker of the House, Kevin McCarthy. That was something that seemed to be on the agenda, but we didn't quite get clarity of whether or not that was discussed. What kind of military aid could we be looking at from the U.S. to Taiwan?
Well, the United States is the most important supplier of weaponry to Taiwan. The United States is obligated under legislation to do so. It has done so over the past many decades. The Taiwanese want to be able to show that they are willing and able to defend themselves. That will go a long way in convincing the United States and allies to help in its defense if that were to come to that point. It is also really important that for Taiwan to show its ability to defend itself as a precaution to ward off or potentially stop China from considering taking a military step if there were an even further escalation of tensions.
John, thanks very much for joining us. Bloomberg's John Liu reporting from Beijing. Now, all eyes in terms of economic data are on U.S. CPI. That comes out on Wednesday. Economists expect a monthly increase in consumer prices on par with advances seen over the previous half year. That will test the Fed's mettle and set us up for a decision that comes at the very beginning of May. Joining us now for a preview is Bloomberg's Simone Foxman. So, Simone, this is a very important piece of data, but it should be said we still have a long way to go before the Fed actually meets.
Absolutely, and that's partly because the core CPI reading that the Fed looks so closely at, as I know both of you know, expected to increase 0.4% on a month-on-month basis. That's very similar to what we were looking at last fall at the time that the Fed was really in the midst of its interest rate hiking cycle. What we may see from the headlines, however, is the weakest inflation growth in 2 years on the headline numbers space, expected by Bloomberg economists at 5.1% year on year. But that includes things like energy and food. And we looked at that OPEC decision last week to cut production further, and that may sort of throw a wrench here into that overall story because we'll potentially see broader prices increasing faster on the back of energy.
Well, Simone, at the end of the day, we are a markets show. So talk to us about the trade here. It seems like the easy trade to go is to really just continue the carry trade that's been working for a lot of investors that are willing to take on that EM risk. How long is that going to last?
Yeah, that carry trade coming back into play this year with 17 of 23 emerging market currencies rising against the U.S. dollar. This is a trade that we understand, and Citi points out, works very well when we see these U.S.-centric recessions. That said, I really would contrast this with what we're going to hear out of the IMF meetings this going on in Washington this week, which is a much more dismal picture. The weakest five-year growth outlook since 1990. And when we think about this, I really want to point you to Egypt. I'm just back from the Middle East, so this was a story that was on top of all of our minds. This is a country that had one of the strongest carry trades, so again, this hot carry trade, for many years, but now has been forced to turn to the IMF for aid. And one of the things the IMF has wanted it to do is make its currency much more flexible, but that's pushed it into this bad situation where it has this ongoing inflation problem. And so the IMF is really going to struggle, particularly on the frontier, maybe not as much in the emerging market space, to try and figure out how to deal with this. And we're watching really debt crises escalate around the world. Yeah, and we're going to be following the spring meetings very closely on that note. Simone, thanks so much for joining us. Bloomberg's Simone Foxman talking to us about the, the carry trade that could work, but obviously can be can backfire in certain situations. In focus this week for us is going to be U.S. bank earnings. Investors are going to be watching for what executives say about deposit levels and liquidity when banks start reporting on Friday. Sonali, our global finance correspondent, joins us now for more on what to expect. So what are we watching?
We're watching the big banks, of course, but now we're watching this slew of smaller banks, regional banks, mid-sized banks. And the question is, we know already from Federal Reserve data that we had the largest pullback in lending in history in the final 2 weeks of March. We also know that deposits across the industry have largely declined at many U.S. banks for 10 straight weeks. So what does that mean? It means investors are parsing very closely, Matt, how that had spread across those banks. We have gotten a taste already of just how sensitive some of these banks are to any changes in news. Think about the stock movements you've seen in the likes of PacWest when they announced some capital plans here to kind of make it through this volatile period. Western Alliance as well had given an update. It took them a little longer to give a deposit number here, but bankers will be very sensitive. Investors will be very sensitive here to the change in deposit levels, as well as the cost of those deposits and what it means for profitability. And on top of that, the inclination to lend and the market dynamic that might shift a little bit here. The rising rate story was supposed to be good for banks. This is the ugly side.
Yeah, Sonali, I'm really glad you mentioned the regional banks are perhaps just as important or even arguably more important than the big banks here. Who is going to set the tone? First Republic was originally supposed to report before JP Morgan. They're pushing their earnings back, I want to say to April 24th. Who sets the tone, the big banks or the small ones?
Listen, the First Republic story is a story that's underpinning the market gritty, right? Because we knew that the big banks had put so many billions of dollars worth of deposits into First Republic to make them through this storm. So until we hear from First Republic, it's kind of hard to know just how out of the storm we are for the regional banking system, because this is such a big one. And then when you look at the big banks here, they do set the tone in terms of how well they can still do in the light of so many economic uncertainties. So PNC also reports on Friday of this week they will start to set the tone for the non-bulge bracket banks as well. But the next 2 weeks should be expected to be highly, highly volatile as we get more information from many firms that a lot of Wall Street will start to pay attention to that maybe they haven't before.
Yeah, Bloomberg, Sonali, Basak, making a crucial point there, Matt. Essentially, this idea that volatility is going to stick through on both the micro basis, but also the macro one as well, which brings us to some top corporate stories, which, Matt, I think we can count as both micro and macro here. Apple, for example, is one of those examples. A tough start to the year for personal computer makers. Apple's PC shipments, for example, plunging more than 40% in the first quarter. Matt, that's on top of dealing with things like unionization within some of their retail stores. Remember back during COVID, during the pandemic, Apple store closures led the broader market. I thought that was kind of interesting.
Yeah, but of course they sell most of these machines online, right? And there was a huge spike in demand for Macintosh products as well as PCs as stimulus money flooded into consumers and we needed to work from home or go to school from home, so we bought a ton of these products. Now you're just seeing that ebb after the big wave. Samsung, by the way, is cutting its memory chip production after reporting the slimmest profit since 2009. That's a significant step towards ending a supply glut that has created prices, that cratered prices across the industry. And this is obviously tied to very closely, directly to the Macintosh and PC story. Right now, you're seeing a number of U.S. chip stocks fall, but you're also seeing some rise in the pre-market. Micron, for example, is up 4.5% in the pre-market as Deutsche Bank's analyst Sidney Ho says they could profit off of this production cut at Samsung.
Yeah, Matt, you know, it's interesting. I love the chip story because I feel like for a very long time, and arguably we still do, we look at commodities as kind of that global bellwether for growth and for expansion. But now as we kind of enter this tech era where, to your point, the story with Apple, the story with even car makers, for example, chips are at the core of that. So if you start to see that demand even slowing, whether or not Samsung makes more money on that or not, at the end of the day, it is kind of indicative of a slowing global economy. Then factor in the EV picture on top of that, for example. I had a fun fact. I think Ed Ludlow, our Bloomberg technology correspondent, told me that it takes more chips to create an EV, an electric vehicle, than it does a regular vehicle, which I thought was interesting and brings us. Sorry, go ahead.
Well, I mean, this brings up an interesting dichotomy, right? Because there's a huge glut of chips for PCs, and nobody wants to get near a PC anymore. So zero demand for those products. On the other hand, there's still an incredible shortage of chips for cars, and everyone still wants to buy one of those.
Yeah, 100%. And that factors into the inflation story as well, which brings us to our next mover here. Tesla, for example, planning on building a large new battery factory in Shanghai, adding to its EV factory there. Matt, we kicked off the show with geopolitical tensions, and here we are really connecting that to the corporate story.
Yeah, absolutely. And I love this story because of the product. The mega packs aren't batteries for EVs. They're like $1.5 million storage units that are utility scale. So utilities, governments, institutions, industry is going to be buying these mega packs. They can power 3,600 homes for an hour. They hold 3 kilowatt hours of power, and they connect to all sorts of other Tesla products, a power hub, and even an energy trading platform that makes it, I think, all the more interesting.
Yeah, and we should mention that Tesla shares were higher by about 0.1%. It's interesting. We're talking about all these kind of micro corporate stories, and yet the shares themselves not moving a ton in the pre-market. It really speaks to just how much lack of liquidity there is out there, given a good chunk of the world is off today.
That is one of the things we're going to talk about with Matt Maley, but we'll focus in on the earnings story, especially kicking off with what Sonali was telling us. What are we going to hear from the banks? Also, obviously, we still care about the inflation print coming out Wednesday, driving the Fed story. We'll put a lot of questions to Matt Maley this morning. He's a chief market strategist for Miller Tabak, and we're happy to have him. This is Bloomberg.
This is an excellent jobs report. You're seeing record low black unemployment. You're seeing record low unemployment among people who have been left behind. And the best news for me is higher percentage of people working in the workforce.
U.S. Commerce Secretary Gina Raimondo there discussing the March jobs report on Bloomberg, and it was a little bit better, Critty, than we were anticipating. Wasn't really a blow-away number in either direction, right? What did you pull out of it on Friday?
Yeah, the fact that the margin of the beat was much, much smaller, and that in an era where we think we've had 11 beats so far consecutively is progress at the end of the day. But look, no one's really going to trade anything until they get that CPI number. So even when everyone returns from Europe, from Asia tomorrow into tomorrow's trading session, it's still going to be a wait and see approach to see, is CPI going to come back?
We had a bet once on CPI. Remember this?
Sure, rub it in my face.
We bet.
First thing Monday morning. Go ahead.
Last June, the CPI peaked at 9.1%, and it has been retreating, right? But just not fast enough for the Fed. They still have to raise 25 basis points.
And if I remember, I lost the bet because I very specifically said that I think commodity prices were coming back up. Now, I was about 9 months late in that call, but here they are coming back up. So let's see if that shows up in the headline print.
A little bit.
I don't know, man. 85
creeping higher. We'll be watching that because that actually could move depending on what goes on in a lot of economies around the world. Coming up, we're going to get you caught up on some of the top news from around the world. Your first word is next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Matt Miller in New York. Anna Edwards is off today. Let's keep you up to date with news from around the world. Here's the first word. In Tennessee, local leaders will decide this week whether to reinstate 2 black Democrat lawmakers expelled from the Republican-controlled state legislature. Each says he would accept. The 2 state representatives were expelled after taking part in a gun control protest on the House floor. The Biden administration is weighing its options after a federal judge in Texas suspended approval of a drug used in medication abortions. Health and Human Services Secretary Xavier Becerra tells CNN the administration has already filed an appeal. Democratic lawmakers have urged the White House to ignore the judge's ruling. A new report blasts the way that failed crypto exchange FTX was managed. The report was from the firm's creditors said that FTX lacked fundamental financial controls, stifled dissent within the company, and joked about losing track of millions of dollars in assets. It blames hubris, incompetence, and greed on the part of Sam Bankman-Fried and top executives. Bankman-Fried faces trial in October. In sports, John Ram of Spain came from behind to win the Masters Golf Tournament. Rahm's final score of 12 under par was 4 shots ahead of Brooks Koepka, who led the first 3 rounds, and Phil Mickelson. It's Ram's second victory in one of golf's 4 major tournaments. Matt, are you a golf watcher?
I sometimes watch Phil Mickelson.
Is that how you say it?
Yes. He's one of the most famous golfers in the entire world. I actually I have had the privilege of going to the Masters a couple times. For me, it is the best live sporting event you could attend. Bar none. I like it better than motorsports.
Isn't golf like the slowest sport there is?
I think it's so much fun to watch. The atmosphere there is incredible at Augusta, and you can walk along with your favorite golfers. So I actually walked an entire round with Phil Mickelson one year, which is something I'll never forget. It was such a positive and fantastic experience. I was blown away by his move to live golf recently, and it's great to see him doing well back in Augusta.
You know, when I think golf, I immediately think Tiger Woods, and we have not once mentioned Tiger Woods and his injury in this whole conversation.
True. I was watching some interviews with Tiger over the weekend. I think everybody still tunes in to see how Tiger does, but he's a long way from a comeback, baby.
Yeah, we're going to have to ask our next guest whether or not he's a golf watcher.
I mean, I think a lot of older white men watch golf, the hope is that diversifies and the sport grows as a result of people like Tiger. Coming up, we're going to talk to Matt Maley and Miller Tabak. This is Bloomberg Surveillance Early Edition. Here's what you need to know. A U.S. Navy destroyer makes a show of force passing through waters claimed by Beijing in the South China Sea. This comes as Chinese warplanes cross into Taiwan's air defense identification zone. And investors will have some important data to consider this week. 3 Wall Street banks report earnings, while the U.S. releases key inflation figures on Wednesday that you can't afford to miss. Plus, it's been a tough start to the year for sellers of personal computers, but especially for Apple. Its Macintosh shipments plunged 40% in the first quarter. Watch Lenovo, Dell, and HP today, as well as the chip makers. I'm Matt Miller in New York with Kriti Gupta. Anna Edwards is off this week. And Kriti, we are seeing some real moves pre-market amongst especially those chip makers, but otherwise, there's not a heck of a lot of volatility in the market right now.
No, there really is. And I got to say, the macro is a little bit boring today, but we got to check it anyway, because you never know. In a light volume environment, you could start to see major moves. And that's the danger of a day like today, where you have Europe and a good chunk of Asia actually off for the Easter holiday. There is no real direction, although I have to say, even ahead of the CPI report on Wednesday, will we get any real direction tomorrow? Nevertheless, like a look at futures, they are virtually unchanged, 41.33 on the benchmark index. To me, I think the bond market story is far more interesting than the equity story, at least on a macro basis. Take a look at a 10-year yield at 3.36, lower by about 2 basis points. At the same time that we're talking about, well, a still hawkish Fed. How much of that is priced in? This is a bond market that does not believe that the Fed is going to be hawkish for much longer, that they're going to change their tune, just like they did when talking about whether or not inflation is persistent or transitory. That seems to be a little bit of deja vu. Nevertheless, 3.36 on the 10-year yield. What it's not doing is affecting the currency markets, and this is what I mean by extremely light volume. We are in a trading session where the dollar's moves. The biggest contributor to the Bloomberg Dollar Index is the Mexican peso. Take a look at this. Dollar Mex lower by about 0.2%. Even that is not a major move. Nevertheless, it is the biggest contributor as we talk about not just inflation here in the States, but inflation around the world, specifically in Mexico. Commodity exposed, very vulnerable there, coming down as well. Some good news for those central bankers across the southern border. Brent crude as well, an 85 handle there. Is that the bellwether, though, to keep an eye on as we talk about global growth? Maybe not on a macro basis. I would actually argue some of the pre-market movers are. Take a look at Apple shares, for example. Their shipments of personal computers declined by 40% in the first quarter. At the same time, the company is dealing with unionization in some of their shops. The shares right now are actually down about 0.6%. So you are seeing some weakness in Apple. How much of that goes into what you're going to see in the regular trading session? We're going to keep an eye on that. And of course, a big part of the tech story is going to be the chip story. We're watching U.S. chip makers after Samsung said it's cutting its memory chip production, reporting its slimmest profit since the 2009 financial crisis. That's the deceleration that we're really keeping an eye on. The read-through of Samsung, by the way, is coming right into some of the chip makers like Intel, down about 0.2%. And although most of the chip makers are lower, there are spots of green. Take a look at Micron Technology, higher by, get this, 6%. So again, some of that U.S. focused story really gaining a little bit of steam on the back of the Taiwanese president's meeting with Speaker of the House Kevin McCarthy. I want to also hit Tesla here. Shares at about 185, higher by about 0.2%, as it plans on building a large new battery factory in Shanghai, adding to its EV factory there. I know for a fact Matt has a lot of thoughts on that.
Well, I'm very interested in the product. The Mega Pack seems pretty cool to me, but I'll leave that aside for now and just say the NASDAQ 100 posted its best quarterly gain since June of 2020. So tech stocks have been rocking it, especially the biggest ones, or really only the big ones. But with earnings kicking off this week, will the results help this rally in big tech or hurt it? We asked a few of our guests.
The decline in the yields is actually driving tech stocks. And if you take a look at the quintessential FANGmen, they peaked at 28% of the S&P. They troughed at around 18, and they've really inched up recently. And that's been because, that discounting mechanism, which is represented by the yield, has resulted in those long tail cash flows being worth more.
These tech companies, if we're talking some of the bigger ones, I think they're defensive in the standpoint of the health of their balance sheets. You can see that when the banking crises erupted, that even some of the bigger FANG companies actually outperformed on a relative basis because essentially their balance sheets are stellar.
The cost cutting, once that started to happen, the bottom in tech, in my opinion, was done. And that's why I believe there's still another 10 to 15% upside in tech.
If you look at the 7 biggest tech stocks in the U.S., I think they make up almost, more than 10% of the S&P 500 in terms of market cap. And that's only going to grow as people find that as the only place to hide. But once earnings start to slow down, you should see that, you should see this segment you should see their share prices start to fall.
Joining us now is Matt Maley, Chief Market Strategist at Miller Tabak. And Matt, I'd love to get your thoughts on the tech rally we saw in the first quarter. Obviously, earnings matter, but I guess it's also important that central banks are looking like very much near the peak of their rate hike cycle.
Yeah, man, I think we do have to be a little bit concerned about the tech stocks here. I mean, they've had this great rally. It's been a little bit on the narrow side, I'm afraid, although it broadened out a little bit for a short time at the end of March, but it's kind of going back to be a narrow one. But the key thing is that, a lot of these names have become quite expensive again. They're not as expensive as they were back in at the beginning of 2022, but they're still quite expensive, even those big cap names. And now we got news, like you mentioned, out of Apple that you just talked about. We also have Taiwan Semiconductor talking about their sales being down. That came overnight. So we have a situation where, if earnings are going to kind of start coming down, people are going to pay attention to that as we move into the second quarter. Because, I mean, I guess the biggest thing that I always note is that if we are headed towards a recession, and it seems more and more likely that we are, when interest rates roll over, that's actually not positive for stocks. When you're headed into recession, interest rates and stocks decline in tandem because people start to focus more on those earnings, because every recession since World War II has seen a decline in earnings.
So in that case, I mean, that makes me a little bit more worried about stocks, tech stocks, and stocks in general. We've got rates at relatively high levels. Are they still does that still provide a headwind for stocks? I mean, are they still attracting investors to the rate space rather than looking at equities?
Well, I think it has to. I mean, you can get these, it's going to be interesting in the next couple of weeks here. People will be doing their taxes and doing their own taxes, but talking to their accountants and stuff. And some of these people are going to say to them, geez, you still can get 4.5%, 5% in cash. That's not a bad situation where if we are indeed heading into recession. And again, we have to remember is that usually when interest rates top out and start to roll over, it's not a problem. It's actually quite bullish for the stock market. But if it's signaling that we're moving towards a recession, that means lower earnings. When you got a stock market trading at 19 times, almost 19 times earnings, and you have the NASDAQ, the NDX 100 trading at 24 times earnings, that's not a good situation to have earnings coming down, because that means that those forward PE ratios are actually a little bit higher.
Well, Matt, I'm glad that you're really focusing on earnings here. We had Stifel's Barry Bannister on Bloomberg Television last week, and he said profit margins have peaked for the decade. Yet, this is a market that is very much trading on profit margins. You see it in Tesla, you see it in FedEx, you arguably even see it in some of the other major big tech names and biotech names. How do you square that with kind of this one-time reward of maybe consolidating, being more cost efficient for a more longer time frame?
Yeah, we like to hear the situation with that they're going to be cutting costs. I mean, all these layoffs. One of the biggest concerns, of course, is that in some of the names like Amazon, Google, it's not just been one round of layoffs; it's been 2 or 3 rounds of layoffs. Is that something that's going to broaden out to more companies? If that's the case, yeah, again, at some point it changes from cost cutting to, oh my goodness, we're headed towards a recession. And again, like I said, every single recession for the last 70 years has had a decline in earnings. And that's not good in a stock market that's expensive. And I guess my real point is that we've had this big change where we're moving away from free money that we had, of course, in 2020, 2021. The unwinding of the leverage that is involved in that situation with earnings coming down almost has to take the market a little bit lower. That doesn't mean we're falling into a repeat of 2008, but every single bear market since, especially one with a recession, in the last 70 years has taken the S&P down to at least 15 or below 15 times earnings. Right now we're at almost 19 times earnings. That just doesn't work out. I mean, I guess my point is, even if rates come down a little bit, it's not as bullish as people think, if indeed earnings are going to come down a lot.
Well, Matt, I'm really glad you used the word leverage there, because as we start to see potentially the market be right and maybe even get the cuts that are priced into the market, I wonder how many of these S&P 500 companies that have really been running on the cash they accumulated during 2020, during that easy money policy that you were talking about, are going to go back to an era of debt issuance and taking on more leverage. Do you foresee that by the end of this year?
Well, that's the one thing that's going to be very, very difficult for them. And that's another reason that we're worried, is that, with interest rates moving up, they're taking on more debt at higher levels. And the big concern that we have with a lot of highly leveraged companies is that they have a lot of debt rolling over the next 2 or 3 years. They're going to have to roll over at much higher levels. How are they going to, if they're already raising, some of these high yield companies, they're already running on razor thin margins as it is. If those costs go up, all the layoffs in the world can only help so much if the economy's slowing, if interest rates are rising, and the issuance of debt is going to be a bigger problem for them than I think a lot of people realize.
$1.5 trillion in debt coming due. I think before 2025 is the big Bloomberg headline over the weekend. Matt, in terms of stocks, in terms of the recession, we usually see the S&P 500 peak months before a recession starts and then bottom before a recession ends, with a significant decline, obviously, in between. What kind of recession should we be expecting here? Are you looking for a long and deep recession, or is it still a short and shallow recession that's your view?
Well, I think we're going to be, it was going to be a deep recession. Again, I'm not looking for what we saw in 2008. I guess my biggest concern is that it doesn't always take a deep, nasty recession to hurt a stock market if the stock market is quite overvalued. And we saw this in 2000 to 2003. In that time frame, we had one of the weakest and one of the mildest recessions ever. And yet the stock market got clobbered. Now, again, I'm not looking for an 80% decline in the NASDAQ like took place back in that time frame. But the point of my real point is that we had such an incredibly overvalued market back in 2000. This time it's not quite as overvalued, but it's still way overvalued. And again, for it to come back and get in line with its fair value to normalize the interest rates, that means the stock market has to normalize. And that's, I'm afraid, even if we don't have a really deep recession, it still means that the stock market's got further to fall. And I think there's a very good chance that will test and maybe even undercut the lows of last October.
So you don't need a long and deep recession to hit stocks hard. Great point, Matt. Thanks so much for joining us this morning. Really appreciate your time. Matt Maley of Miller Tabak. Coming up, global financial leaders are gathering in Washington for the annual IMF World Bank spring meetings. We're going to cover the importance of those next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with Nobel laureate Paul Romer. That's at 4:30 p.m. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kriti Gupta here in New York. Anna Edwards is off today. Now, the IMF and the World Bank are set to kick off their spring meetings in Washington today. The World Bank is pushing to resolve the mounting debt problems of poorer countries and present concrete proposals to address some of the biggest restructuring roadblocks. Michael McKee, Bloomberg International Economics and Policy Correspondent, joins us now. And Mike, you know, the interesting thing here is that China is the biggest creditor to a lot of these poorer nations.
Which is where the problem has started, because the IMF and the World Bank came up with a plan called the Common Framework some years ago to help countries in debt distress work it out with creditors. But China has become one of the major creditors in the world because of their Belt and Road Initiative, and they are much more concerned with their own recovery than with the rest of the world's. And so it's been hard to get them to work with the rest of the IMF and World Bank. China is the one bringing the World Bank into this. They want the development loans also included in restructuring. But so far, nothing under the Common Framework has worked. No country has gotten any kind of debt relief. This will perhaps mark some incremental progress towards it, the meetings, but I don't think a lot of people are expecting an agreement to come out of this week's meetings.
Well, Mike, the IMF Managing Director, Kristalina Georgieva, I think at the last spring meetings had warned early on, before the Fed's tightening cycle had really taken out, had she warned about a kind of wave of some sort of EM sovereign debt crisis. And I wonder, a year later, are we really seeing evidence of that showing up?
We're seeing a lot of countries in debt distress. We're only seeing a handful that are actually on the brink of default or unable to pay their loans. But with central banks around the world, not just the United States, but around the world, raising interest rates, that's made the debt burden for a lot of these dollar-denominated debt countries to fulfill much more difficult. And so, yes, it has become an issue. It's one that everybody anticipated, and that's one of the reasons they put this common framework together. It just hasn't worked so far.
In terms of rates, I got to ask you, since you follow the Fed so closely as well, we had, I think last week, the RBA pause for the first time. The RBA was really the leader into the hiking cycle. Do we expect the Fed, after this increase in May, to pause as well and lead the rest of the central banks around the world into a new phase?
Well, I hate to say we're data dependent, but we're sort of data dependent in that the Fed wants to pause after one more round, but we'll have to see. We get CPI this week. We'll have to see how inflation is doing. The Fed will pause if they can, because they're at a very high peak right now. They're just be over 5% for their base rate. But you've still got the ECB, which has got a ways to go before they think they'll go 3.5, so maybe a couple more 25 basis point moves. And the Bank of England's in this weird position where they have raised rates a lot, but inflation hasn't gone down there because they've got Brexit issues on top of the same global inflation issues everyone else has. So it's not clear what they're going to do. And other central banks around the world, especially smaller ones, should be able to pause after the Fed with maybe some minor adjustments because they don't have to chase the Fed higher in order to maintain their currency values.
All right, Mike, thanks very much. Michael McKee there, Bloomberg Television, international politics and economics correspondent. Bloomberg TV is going to have a global team coverage of the IMF World Bank meetings, including interviews and live programming from the site of the event. Obviously, this is one of Tom Keene's favorite weeks all year long. Now, coming up, car makers riding a wave of pent-up demand. We'll dive more into the autos picture, especially on the chip side of it and the inventory side amid higher financing costs. Look at that Rolls-Royce, gorgeous. This is Bloomberg.
We have the U.S. as a priority in our company for the next couple of years. And obviously, we need to have more tailor-made products made here in the U.S. and in the North American region. And the fastest way of doing that is to have design customer clinics so you gain more speed and you have custom-made vehicles for the American consumers. So that will be our main focus over the next couple of years. How do we accelerate this trend?
That was Pablo Ducey, the CEO of Volkswagen North America. I sat down with him at an editorial board meeting led by our Detroit bureau chief, David Welch. David joins us now to talk about the car makers in the U.S., what they're facing here. David, for the longest time, you couldn't get a car for months and months. There was nothing on dealership lots. Obviously, they're trying to meet that demand by boosting production, but doing it at a time when interest rates are rising and making monthly payments more expensive for everybody. How is this all playing out?
Yeah, a lot of crosswinds here, and it's a bit tough to read the auto market. But most of the car companies will tell you that over this period, last couple of years, with production delays, production cuts, chip shortages, there are about 4 to 7 million people wanted a car and couldn't get it. And now that they have more chips, they're not totally back to normal, but they have enough to really get production going at a pretty decent clip. A lot of that pent-up demand is being met. So the first quarter, we sold cars in this country at a rate of about 15.5 million a year. You know, in a good year, we were up over 17 and kind of mid 16, say 16.5 million in a solid year. So we're not totally back to normal, but we're getting there. To me, the key indicator is pricing. Vehicles have been selling at a big premium, and we just, there's a little bit of discounting, but still vehicles are expensive right now.
Right.
We're not seeing pricing collapse, so I think there's still good demand.
Well, David, part of that is going to be the tax piece of the equation. These EV tax credits that we've now gotten a little bit more explanation and information from when it comes to the IRA. How does that square into the prices at a time when now a lot of these car makers have to be competitive with Europe as well?
So the tax credits will, that'll help bring EV prices down, but those prices are still way higher right now. The average vehicle sells for about $62,000. The average gasoline-powered vehicle sells for just under $50,000. Both are very high prices, by the way, historically speaking. So you'll get EVs kind of more competitively priced, but they're still essentially selling like a luxury vehicle does.
We saw Tesla cut prices. Does that lead to the industry starting to, drop its guard?
You've seen some companies have done it and some have not. So Ford responded, they cut prices on the Mach-E, but General Motors has. Now, GM doesn't have any production, they don't have any inventory. So maybe once you see more Cadillac Lyriqs and Hummers out there, maybe they'll have to start discounting. Right now, some of the companies, if they're just starting production, they haven't, but we'll see. I think eventually they will, because I do think interest rates matter, inflation matters. Consumers need cars right now because of pent-up demand, but eventually all of that catches up, and I think you'll see some pricing. For me, the big key here is to get pricing back to where it used to be 3 years ago, sort of in normal monthly payments of $400, $450 a month. Prices don't need to fall, they need to collapse, and I'm not sure that's going to happen. So I think we'll see expensive cars for a while.
It's a very good point, David. I think the affordability levels are beyond what most people can believe right now. Bloomberg's David Welch reporting live from Detroit. That's it for Early Edition. Surveillance is ahead. We'll hear from Tony Dwyer of Canaccord Genuity, among others. This is Bloomberg.